Good morning. Welcome back. Today we're talking again to Kurt from Farmerland, PePeMints, and all that other good stuff. And today he's got something new for us. Today you're talking to us about Janis, which you've been kind of teasing me about for months now. So I'm super curious. I guess we're going to learn all about it today. How's your day going, sir?
Doing very well. How are you?
Another day in paradise, or another day in paradise. So, what is Janis, and what do you have? What have you been cooking for us over there?
All right. So, Janis is a decentralized exchange on the Arbitrum network. And so, I guess now I will probably share my screen if that's all right with you.
Yes, please.
So, I know you always want me to share my screen. So, I have shared it, and so we have here the Janis.capital website. So you can see it does bear somewhat of a resemblance to the Uniswap website, except it is themed based on Janis Joplin. And then the double entendre is that Janis, Janus Capital Group was a very successful group of funds in the United States, and basically merged into one of the major funds now. So basically, the point of Janis is that it is going to be a community-owned, decentralized exchange, and I say community-owned because it is going to have a really significant portion of the outside revenue coming back to equity token holders. So I can show you on the docs we have a flow chart that actually shows where all the income goes. Whoa. Okay, here we go. So we actually have two revenue sharing pools. One is for J tokens, which is the normal DEX token, and one is for JO, which is the Janis ownership tokens. So we actually have the community fair launch starting today over at janiscap.capital. If you click enter and then fair launch, you'll go right there. We actually had to correct the countdown, so it's appearing correctly now. It starts at 5 p.m. Eastern or 9 p.m. GMT. So the community fair launch has basically 100,000 J for sale and 10,000 JO, Janis owner tokens, is given as a free bonus. So the procedure is, and this is sort of a procedure that is derived from something that Grizzly Fi did. The procedure is basically we give a guaranteed 3x on Janis tokens, J tokens, to everyone who participates with any amount of Ether in the community fair launch. Now, how would we do that? You might be saying, well, okay, what the heck is this guaranteed 3x? That doesn't sound right. Well, so as the people who add liquidity on a token, we can actually start the price at whatever we want. That's sort of a little known fact, which is sort of well known to DeFi users, but little known to everyone else. So if we collect a certain amount of Ether for the presale, we can add liquidity with 80% of the Ether and 29% of the tokens to produce a 3 times the price that the public got. And so the amount of Ether that comes in is not really a variable in that. We can do this with any amount of Ether that comes in. Of course, in order to prevent the price from dropping really quickly, we have to release the tokens steadily. So we release them linearly for 40 days, 2.5% a day. And so that means, that ensures that the price doesn't drop too quickly for J tokens. So when J tokens are released, when liquidity launches at 3 times whatever the public pays for them, basically everyone will get a chance, because all ways of getting J tokens, they won't be released in bulk. They're all vested. So all allocations are vested. The public presale comes out more quickly than anything else. So at the beginning, most of the emissions will be from the public community fair launch. But so then I guess backing up, so what do you actually get when you do the community fair launch? And again, so if you want to sort of get a reference for sort of what you receive, you can look at Grizzly.fi, but we give you more. So Grizzly.fi was another project that did a community fair launch. And when they did it, they brought in about 26 million on their community fair launch on BSC. So this was very popular when they did it. But so they didn't have an extra token. They did the community fair launch and the guaranteed 3x just on Grizzly, just on GHNY Grizzly Honey tokens. So we are actually giving you the amount of J that you bid on in the community fair launch. It simulates basically everyone putting in money for these tokens, and then the launch process raising the price. So you also get 0.1 JO for every J purchased. So we're giving away basically 10% ownership. We're giving away 10,000 JO, and there's only 100,000 of them ever. So that means that this pool here will receive 67% of outside revenue, 67% of non-extinction deposit fees, and 67% of non-native extinction deposit fees. Also, 50% of LP trading fees, and that will go to the JO ownership pool. So that will come out as wrapped ether. So these LP trading fees, we're going to liquidate them and then send them to you. Also, people will be able to sacrifice J tokens in order to get revenue from this revenue pool. So that's like a form of an extinction pool, which we'll talk more about later. So so that's basically what you get. I mean, so does that make sense so far? Like, I guess what people receive in the community fair launch and how the guaranteed 3x works?
Yes, to me, yes.
Yeah, so basically, I guess just to make sure that people understand, so in a regular ERC20 fair launch, basically what happens is it's not fair. Like, so the name fair launch, like, usually doesn't make any sense, because what happens is usually the creator launches a token, and then either just nothing happens, nobody buys, or, a bunch of people bought a bunch of buys, and then any real person who wants to try to buy ends up with a higher price. So no two people usually end up paying the same price during a standard fair launch procedure. So what the community fair launch basically does is pool the ether that comes in for 3 days, and then basically gives everyone the same price. So everyone who contributes ether gets the same proportional amount of J and JO. And then so that then you don't get you don't get the tokens all immediately for J, but you do get the tokens immediately for JO. So J is vested linearly for 40 days. JO you get immediately. So we're not really, so because it's a free bonus, we're saying that JO, should be deposited in the ownership token pool. So we're giving it right away. It's not about price support for JO. Really, the price support has to go for J. And so, however, both of the tokens can be deposited in these revenue pools. So one thing that we could talk about is like the specifics behind all these little boxes. Like, how exactly are we getting the LP trading fees? Like, so, LP trading fees actually accrue as LP tokens. And so the house ends up with LP tokens for all pairs that are traded. So the house will always end up with like a whole wallet full of these little LP tokens. And so what we're going to do is come up with a script to liquidate them. So, and then in Uniswap, these fees go all to the LPer. Uniswap doesn't even take any. But in Janis, we take 5/6 of them, and we revenue share them. So we have a script that liquidates them, and then they're split between the J and JO pools. Now, you might be asking, like, wait a minute, like, how can they share this much? Like, how can they give away this much? Because, like, if you run businesses, you might be like, well, you need revenue to run a business, right? Well, the reason why we can put this much of the revenue into the JO and J ownership pools is because the creators are going to be major JO holders as well. So we want to make the JO ownership pool really good and receive the majority of the income, because the creators themselves, that's how we also make money. So basically it is truly like real ownership, because the creators and regular users actually harvest money the same way. The only question is, what percent does everybody hold? And that's, a question for the tokenomics spreadsheet, basically. So, we can look at that later. Like, this is the tokenomics spreadsheet for JO. And then this right here is the tokenomics spreadsheet for Janis. But we can come back to that first. But I want to emphasize the fact that these, what these boxes are and how they contribute revenue to you, the owners of Janis Exchange. We went over the LP token trading fees, and sort of, we shouldn't underestimate these. I saw in a post the other day, even Cyberswap just exceeded 3.2 billion in overall trading volume. That's 3.2 billion with a B. So, I'm not saying we will definitely have that much, but you can't underestimate, how much volume these dexes get. People, they really do fulfill a business need of people who use blockchains. We really are providing services to users. People need to swap. And so if we end up with good service and with users on our website, we will provide services and they will swap with us and we will make money. That's just the way it is. The real question is, like, why don't other dexes give away the revenue like this? Most just give most of it to the LPers, but then they also give away like a shitcoin yield to the LPers. So then LPers end up getting like to double dip. But so we're going to make sure that the shitcoin yield is sufficient for the LPers, and then so we're going to take a lot of the trading fees and give it to JO people. But also, so we also have JO tokens to give away to people like partners. So, if there are people who are major LPers, we can actually give them some JO tokens, and then they can like reharvest their fees. So we can be fair to people by giving them tokens to represent their contribution, and we can come up with a formulaic way of doing that as well. So one other sort of source of income on here, which sort of requires explanation, is deposit fees. So we can actually take care of that one really quick. So non-extinction deposit fees will be 0.25% for natives. And then so that will be divided upon for the formula. And then so we also have what's called extinction pools. So we have a separate a pile of tokens that's minted just for what we call an extinction supply. And what that means is we have additional pools that don't affect the regular MasterChef emissions. So the standard MasterChef pools have, multipliers from a non-pre-minted supply. And, we just continually mint J tokens for the regular pools. And so then you could make a point that, so if we start up another pool to reward other tokens, so if we start up other pools, how would that affect the permanent pools? So if we didn't do anything about it, every additional pool we add would take away from those permanent pools. But so the extinction is a separate supply of tokens where we can start extinction pools that emit this other supply of tokens, and it will keep the other pools the same. So, and the point is, we have a separately pre-minted supply of tokens for this. So there's a certain limit to how much of that we can do. Like, so these other tokens are part of the initial supply, and so there's only a certain amount of extinction emissions that can ever happen. But so these extinction pools give us the ability to take any token off the market in exchange for J tokens. So like this J transaction fee revenue pool, you'll have to burn J in order to enter it. So that's kind of like an extinction pool, but we will also have pools where we will accept like Farmerland wheat and RB10, and we will and those deposits will be considered burned, which means they'll go to us, and then after that you will receive J tokens for a certain amount of time, and they will come from a separate master chef, and they'll be on a separate website. But if there are non-native tokens we do that for, you JO and J holders will get liquidated wrapped ETH from those as a percentage as well. So then we have the upper part on the left here, which is B2B services. So I guess we could have like a sub-label on this whole pink part here called B2B services. So one thing that you should know about running a DEX is how much money you can make on B2B services, and it's really high. Like, so, you know, you will often see DEXs selling services like pools. You know, you'll be able to just buy a pool, or you'll be able to buy a farm. Like, for example, you know, PancakeSwap, they actually had auctions for farm slots. Some people don't know this. Some people do. But if you wanted to promote your project on PancakeSwap, at least for a while, I don't know if they do it anymore, but you used to be able to bid on a slot for a monthly farm on PancakeSwap to be then an official farm. And then, you know, they would also sell you a slot as a syrup pool. So, you know, if Johnny, project manager, wants to have a syrup pool on PancakeSwap, they might be able to do it for you for a little moolah, you know? And then, so how does that moolah accrue to Pancake token holders? It doesn't. And so that's why Cake is in the shitter. Because, you know, that PancakeSwap Cake token holders, they just have a pool where you deposit and get more cake, or where you get, you know, the syrup pool emissions. But you don't get any real revenue. That you get tokens from those other businesses, but you don't get the payments that go to PancakeSwap. So with Janis, you're actually going to get a portion of the payments that come to us for selling pools and farms. And as far as I know, we're the only DEX that has ever done that, because that's like that is one of those plums that is considered like the sweetest plum, and DEX owners just usually don't give it away. But we're doing it because we believe that it is very lucrative, and also, again, because we are going to be the biggest holders of JO. So we really want the JO ownership pool, and therefore the J pool, to have good revenue sources. So we're giving away the best revenue sources we have. And that's also, so we will be providing sort of full Launchpad services. So, like, for example, you know, obviously from the fact that we're running this many pre-sales in the past, everybody knows we know how to run a pre-sale, take care of the custody of funds. You know, we know how to lock up liquidity. We could even do things like, you know, if the other teams want, we could even implement milestones for them and stuff like that. Then after their project launches its token, we can give them pools, farms, and even extinction pools. Like, if their supply becomes too much, we can sell them an extinction pool, which would then take in their tokens and emit J tokens. we can also, if they're an NFT project, we can actually start an NFT pool. So we can have pools in our MasterChef, some can't, that accept NFTs as content. So we can actually add utility to any NFT set. And we can sell that service. And of course, there are precedents, for other dexes. Some dexes out there have even existed, like Cyborg Swap has existed just to sell these NFT pools, like on Chronos. But so we'll be able to do that just as one of many things we do. And we've learned from many other people who like offer launch pads, like what teams want. And, we'll be able to implement, we'll be able to do stuff like be multi-sig signers for them if they want, and so we'll be able to have all different levels of involvement. If teams just come to us and say, look, we have a project, we just need a place for liquidity, and we need a place for liquidity with a farm for us, then, we can make a deal with them, and we can provide it for them. And they won't have to go through a messy vote escrow process. And I can't emphasize that enough. So when you are a real project runner, a lot of the time, some clunky vote escrow process on the blockchain that maybe or maybe not might get you a pool for a month later, depending on other users, isn't really what you want. Sometimes what you really want is a person you can talk to who can guarantee what you need done. and that latter sort of resource is what we're going to provide. We're going to start out by doing things directly. I'm not saying we will never do vote escrow, because so it is like how MMF showed, it is technically possible to do vote escrow like on top of a system like this, but it would weigh down on the multipliers. And so we want to try to see how it is to do business directly at first, especially because so we have some internal launchpad projects which we think could be extremely timely. And so I guess that sort of segues into the next point, which is, so in addition to sort of external,
I'm gonna want spoilers about that later on, FYI.
About the launchpads
Projects, yeah.
Yeah, so that's what I'm segueing into right now. So what I've been talking about so far was external launchpad projects, so we can make money as a DEX when other teams who are not us want to have pools and farms for their project that they come up with themselves. So that's one sort of stream of B2B launchpad revenue. But there's also sort of internally launch-padded projects, which we have actually already started to develop. So we've actually already had significant work done actually on a leveraged trading platform. And that is important, not because so everybody knows what like GMX and gains have generated very sustainable real revenue. One other thing that people don't know about GMX and Gains, which are the biggest leverage trading platforms in crypto on chain, is that they charge a lot of fees. So if you are doing a trade on Gains, you might pay a 1% fee to put in a 12x long or something. That stuff like that is typical. And that's really just the fees are too high to really attract bigger wallets. So there may be a limit as to like how big GMX can really get when it's charging as high of a fees as it does. So one big thing that we're going to do with the leverage trading thing is make it so the fees for the average user aren't so high, but also so we're going to make it so the leverage trading platform can just charge no fee to another project that we implement. Like, so if we have a contract that's ours that wants to leverage trade, like as a feature of what it does, then that other contract then won't even pay any fees. So, and then now I can explain the reason for that. So why is it so important to me that we have access to a leveraged trading platform with no fees? Well, that's because we want to start a stable coin. So hold that thought for now, but remember for now that this leverage trading platform is going to be used for a stable coin. So now enter Libra Finance. So have you heard of Libra Finance, by the way? I think you're muted.
Of course I am.
Have you heard of Libra Finance?
Yes, but please break it down for us.
Okay, so basically, Libra Finance is it's recoded, but it is similar to Liquidity Finance, but with the LSD liquid staking derivative part added. So basically, what you can do in Libra Finance is stake either Ether or STETH, staked Ether token, and then it's automatically converted into STETH so that the collateral earns interest intrinsically. So, when you have STETH, you earn interest as if the Ether is staked in a validator. So then from so you basically collateralize your ETH or STETH, and then that creates a vault from which you can borrow a stable coin. So you can mint a stable coin, but it must be over collateralized. So most people mint about 50% of the value in a USD stable coin. And then so that USD stable coin actually earns intrinsic interest because it is backed by STETH tokens, which themselves earn interest. So basically what they've created is the first stable coin that basically earns interest by itself. And so would you say that's fair so far?
Yes.
And of course, additionally, you can take it's just like PUSD, like Poliquity. So it's similar to the Liquidity Finance code base in that you can also buy their stable coin off the market, or you can just you can mint it yourself and LP it. They also have some other profitable elements like liquidation. So, of course, it's possible that the price of Ether can just drop to the point where your vault that you have borrowed the USD coins against is no longer fully collateralized or isn't collateralized sufficiently. So when that reaches a percentage when that reaches, the amount that is needed to liquidate, then you can be liquidated, and the liquidators actually gain profit from that as well. So Libra Finance, which we believe we're going to fork Libra Finance too, because Libra Finance, the TVL is actually mega mooning right now. So it's part of this LSD narrative, liquid staking derivative. So right now, people are all about real yield. And one way to get real yield into a stable coin and really make it so that that stable coin is guaranteed to yield interest is to introduce the element of staked Ether, and then some use the DAI vault on gains as well. But so one way of making a guaranteed yield stablecoin is to collateralize it with staked Ether. So the Libra Finance on Ethereum right now is mega mooning. So I watched it go from 25 million TVL to 50 to 100 to 200 million TVL. And when it went from 100 to 200 million, it was like only a few days. But so Libra Finance does have problems. Like they say the tokenomics released tokens too fast, and so we're going to change all of the parameters around a bit, but we're hoping to release a Libra Finance fork on Arbitrum before Libra Finance itself releases on Arbitrum. And so if we are able to do that, I believe we can make a really big splash. We can really gain lots of investment from, really big wallets if we are the only Libra Finance derived option on Arbitrum. I mean, and if we have superior tokenomics, that will also be really good. So right now, Libra Finance is very hot. So what is the problem with Libra Finance? Why is what Libra Finance does sort of not good enough? And the reason has to do with the complicated liquidation process. So if the price of Ether goes down and your vault is no longer collateralized sufficiently, you will get liquidated. So it will end up that your Ether will be basically just liquidated, and you will be just permanently stuck with the USD that you minted. And you may get some like Ethereum change, which was left over, but it's just not a good result. Like, so when people put in their Ether, they really want to get their Ether back out. They don't want to get, whatever else. So, and they don't want something that's half the value. People just don't want to get liquidated in general. So what we're going to do, what we hope to do, this is pretty experimental, but so if we have a leveraged trading platform that doesn't charge us a fee, then what we could do, and this is based on a theory by Arthur Hayes, is we could make a stable coin that consists of 50 cents worth of Ether and then 50 cents worth of a 1x Ethereum short. So we could make it so when people put in $1, that becomes 50 cents worth of Ether plus 50 cents worth of 1x Ethereum short, which in theory should always equal $1. So that might not the numbers might not add up if you do this while charging a bunch of fees, because, the fees can be like 1% and it just might not work. But so we believe that it might actually be fine if we have a non-fee charging leverage trading platform, at least non-fee charging to this contract. So then Arthur Hayes had an idea of making a stable coin like this based on 50 cents worth of BTC and 50 cents worth of 1x BTC short. But I believe that if you did this with Ethereum and also made sure that the Ethereum turned into STETH, then we would be able to give a guaranteed yield on the stable coin, just like Libra Finance does, without having the liquidation.
I'm trying to wrap my head around that. That's super cool. Would that involve a lot of different transactions on the chain?
People. So basically, we can make it so that, yes. I was just hello.
Yeah. Can you hear me?
Yes.
Okay. So does that entail a lot of the way you describe it? That would be a lot of different transactions. I'm trying to figure out how that's going to work.
Basically, on the blockchain, one transaction in a contract can do a lot of different things. So if a user deposits 10 USDT, then we could do one transaction in the contract, which would do all the swaps. So we could swap 5 of their USDT for STETH tokens, and we could do 5 of the USDT into a 1x Ethereum short on our leverage platform. And then we could, give that person back 10 we could give that person back, 10 USDT of our tokens, our stable, whatever we call it, JUSD or whatever. So we could have that all happen in one transaction. So there would be a lot happening under the hood, but there are lots of platforms out there that do, a decent few swaps in a transaction, kind of like vaults. Like, for example, if you've heard of vaults, they do harvesting and swapping in one transaction, and it's not really a problem. It just uses some extra gas. But on Arbitrum, it's not going to be more than $1 to $2 worth of gas, for a really complicated transaction anyway.
Okay. I wonder if we could go back to the basics a little bit. Can you tell me what's the biggest difference between, I know we talked about this before, but what's the biggest difference or changes that you've made to the Uniswap v3 code versus what you're deploying? And also at the same time, why Arbitrum?
Well, okay, so it's actually Uniswap v2, and I can talk a little bit more about that, because so many of the sort of code bases out there are actually more compatible with Uniswap v2 than v3. Like, for example, anything that involves depositing ERC20 LP tokens in a farm is Uniswap v2 or some workaround. Like, so for example, GMD is like a farming wrapper for Uniswap v3 that gives you an ERC20 token when you deposit on Uniswap v3 at a certain tick range. However, if you just deposit on Uniswap v3 by yourself, you're actually going to get an NFT as your LP receipt token. And actually, so many code bases out there like Tomb Forks, Yield Farms, Vaults, everything like that, they're all incompatible with that Uniswap v3 method. So that's why, you know, many projects have come out with farming wrappers to kind of compensate for this deficiency. So in Janis v2, so we actually already have development going on of sort of a v2 of Janis where we'll have Uniswap v3 and v2 running on the same LPs. So what we want to do is make it so that, you know, you'll be able to run the add and remove, you know, functions just like Uniswap v2, but also if you want, you'll be able to use concentrated liquidity like Uniswap v3. So in a future version of Janis, you will have your choice between Uniswap v2 and v3 sort of receipt tokens. So then for other changes from Uniswap, so we actually have pools that can take NFTs as contents. So like I said before, you know, if you have Farmerland NFTs, Minotaurs, farmers, tools, or land, you'll be able to just deposit them in our MasterChef's pools. We also have, you know, quite a few other features which are actually listed on our docs. So we're adding in a stable swap. So it's not going to be there right at launch, but like within a week or two of launch, we're going to have a separate swap just for stables, which is going to be designed for stable price curves and is going to give better rates on stables. Also, we have NFT yield boosters. So if you have Farmerland NFTs, you will be able to deposit them in our pools, and so there are 5 yield booster slots per pool. And we have a formula, which is right here. So there's a base boost and a stat boost. So as some people here know, if you go to farmerland.gg, you'll be able to see, you'll be able to get our NFTs from Farmerland, which is our play-to-earn NFT game. You will then be able to bring them over to Janis with their stats that they have, and you can upgrade those at Farmerland using the wheat token. And you'll be able to get a certain boost. That boost is 2% for Minotaurs and 1% for the others. And there are 5 slots. So the base boost is up to 10%. Then the stat boost is 0.01 per stat. So for example, if you have 1 farmer and 1 Minotaur, ability 10 and 20, you get 30 stat points. So 0.3% for stats. And then 1% plus 2%, so 3% for base. So then you would get a 3.3% boost with those 2 slots filled. And so that's just one example of how you would get your boost. We also have referral. So the Uniswap MasterChef doesn't have referral. I guess that's another technical answer to your question. So you can go and get your referral code now, guys. So you can just click referrals, and then you can click your referral link, and then, you know, you can also take a referral link someone else gives you, paste it in your web browser, and then it saves a cookie, which then says you were referred by that person. When you do this, you get extra tokens. So most referral systems don't have this, but so our referral system gives 3% tokens to the person who refers, and also 2% to the person who gets referred. So if you just use a referral code, you get 2/3 as much as the person who refers you. And that does apply to the community fair launch. So then I guess we've been rambling for a bit. I just want to reiterate the community fair launch for Arbitrum Janis DEX starts today, actually, June 9th at 5 p.m. Eastern, which is 9 p.m. GMT. And so all Ether that comes in is bidding for a pool of 100,000 Janis J tokens, and 10,000 JO ownership tokens will be given as a free bonus. So then once the sale is over, we will launch liquidity at 3x pre-sale price. So everyone gets an instant 3x on J tokens, and they begin to release at 2.5% a day. So the J tokens from the pre-sale release at 2.5% per day. So for 40 days. And so this is the case regardless of how much Ether comes in. And, again, it's similar to the formula of Grizzly Fi, except Grizzly Fi didn't give like an extra bonus token. At any rate, Uniswap didn't do that either. They had like a VC launch plus an airdrop. Also, so the launchpad is not going to be part of the DEX in particular, but so we are going to have this launchpad that has internal and external projects. So we believe that that's going to help, because so the revenue is going to come to J and JO tokens, and we can also have token gating. We can see what we can do to basically force people to accumulate J tokens in the pool in order to get allocations. Governance is going to be done through Snapshot. So many people don't know this, but actually, so you can do governance based on basically any token on this snapshot.org. So many people will ask, like, well, how will governance be done? Actually, it's all done on a third-party website. We have our own code that tells Snapshot how to count votes, and then we can just convene votes whenever we want. It's pretty nice. I guess, so all of these code changes, you might ask, well, okay, this is a lot of code changes. What's being done for audit? We are audited by PePeMints. So PePeMints is one of the top auditors in the space. They are they are a very respected sort of commentator and authority on blockchain security related issues. And we have, all of the findings were resolved. So all severity issues were listed as resolved. They did find some issues, which is always a good thing. And so we resolved all except for the trust issue of admin keys, which is mitigated. And that the trust issue of admin keys, it's like something that it's pretty standard. Basically, because we hold the admin keys, we can do a lot of things. And so we're going to be, we will have protections in place for that.
While you're on that subject, I wanted to ask you a question. I know this is the first project you're having that you're going to have a multi-sig function on it. Could you elaborate on why you made that decision, and we'll go from there?
Well, so the reason is because, well, first of all, it was recommended by our auditors, PePeMints, but also many users just generally tend to look favorably on a multi-sig because it makes sure that people are on board if we move tokens, because so we are going to have partner tokens and sort of ecosystem tokens. For example, in case we need to get a centralized exchange listing, they'll need tokens. And so we have tokens on the side, which the team does have access to behind multi-sig. And basically, it makes sense to make sure that these extra tokens are only moved under circumstances that won't lead to, economic damage to users. So, because there are tokens out there, and then we don't want them to be, just dumped on liquidity, for example. We want those to only be sent to recognized centralized exchanges as collateral for liquidity, for example. So,
Right.
and we haven't really had that issue before, like where we had extra tokens designated for those purposes. And then also, so the multi-sig can function as like a partnership gaining activity. Like, for example, we can have influential people from the community be on the multi-sig as like advisors, and then that could actually help the project because we could have access to prestigious people as advisors.
I like it. I like it. That's one of the things I noticed that was different about your projects, because normally you don't do stuff like that.
Well, in the past, we did time locks on farms. So one feature of multi-sig is that it also has like a time lock function on it. So we can start basically locking functions behind a time lock, and also having them verified by multiple signatures. So we used to just have time lock, which was by one signer. So now we'll basically be able to have time lock and also multiple signers.
Very cool. Very cool. I like it. Okay. So I had a bunch of questions, and I think you've already answered most of them. But part of the question was, why Arby?
Oh, right. So Arbitrum, I think, has a lot of staying power.
Okay.
Like, for example, it is really the most preeminent Ethereum L2 right now. There are some blockchains out there that are like alternate L1s, and then there are some that are like officially layer 2 blockchains of Ethereum. So the layer 2, as a layer 2 roll up of Ethereum, Arbitrum is really the best one so far. So it has sort of like a default, it's almost like the default solution if you want to build layer 2 on layer 2 right now anyway. And the TVL reflects that, like, the volume reflects that. And I don't think that Arbitrum will just fade away like, some alternate L1s, like, because so the bridge from Ethereum to Arbitrum tokens is an official bridge. It is not like Phantom, where we recently saw Phantom had issues because of multi-chain. Well, Arbitrum is not dependent on multi-chain. It has its own bridge. And also, so that's why politically, I guess Arbitrum is a good solution. But in terms of like execution, we also believe that Arbitrum is a good solution because we have actually had notice the differences between some blockchains because we've built on a bunch of them. So when we went on Polygon for Farmerland V1, we actually had just trouble every single day. It was like day in and day out. Nobody could use the RPCs. The subgraph was broken. Just transactions weren't going through. And just using some blockchains can be a disaster. But then, we switched over to Arbitrum for Farmerland V2, and everything, all those problems just went away. Of course, it occasionally has issues, but very much less. You were saying?
Yeah, that's one of my biggest pet peeves. Polygon was like the promise of what could have been but never was. I keep having this argument with a friend of mine about, he's like, let it go. Poly's going to be awesome. Poly's going to be awesome. But then every time I try to go use Poly, things don't work. And then I get back to my original opinion that Poly sucks. Anyways.
Yeah, so my original opinion was actually that Polygon was good, but then actually we saw that Iron Finance brought in a bunch of traffic, and that was like the big warning sign. But then, sort of Polygon became the go-to for like low transaction fee sort of blockchain gaming and other apps. So then the traffic just kind of never went away. So then now, anytime anyone wants to build on Polygon, they're kind of wading through the mud of spam transactions. So I guess Polygon has like kind of an existential issue. And, sort of, is it possible that Arbitrum could one day have similar traffic issues? Maybe, because, we saw that Arbitrum had issues on the day when the ARB token came out. But as of all we can really base our approach on is the traffic situation now. And sort of right now, Arbitrum is much easier to use on an everyday basis than something like Polygon.
Yes, I agree. So you've covered security and all that. I think everybody's questions are always, how can we trust you? How can we do this? How do we know this is going to work? But I think in your case, considering how large your ecosystem is, I think questions like that are kind of silly and, you know, not necessary. But I wanted to bring it up anyways. What do you want to say? Do you want to add anything to that, to the people that will ask that question?
Oh, well, sure. So there are many people who will bring up the fact that sort of, maybe not all of our projects have always been the greatest, but so we have been doing this for 2 years now. We started full-time crypto in July of 2021. And so we have had some projects that went really well, and some projects that were stinkers. For frankly, we had some projects that just went over like a lead balloon. But so we've basically learned what works and what doesn't, and we've seen that we can have some projects that actually last not very long, but do very well. Like, for example, our first yield farms, Polly Wants a Cracker and Stadium Arcadium, were designed to last 2 weeks and 2 weeks only, but they paid out participants very well. But then, okay, so there were also a couple of projects that we released that didn't do well at all, which were like 10, for example, 10 Meg Finance. So 10 Meg Finance was an algo stable that was kind of like Iron Finance, except it only stayed above peg for 2 days and then depegged and then infinitely printed right away. So that 10 Meg Finance, was an enjoyable project for some people, but it just collapsed way too quickly. But we learned from that, and I
did not enjoy that one very much.
Right. And so we have had some projects that didn't go well, but so we did actually send out, cash refunds from 10 Meg, and we gave people future tokens. So, we took care of people, but in the end, we learned what we did wrong, basically, which was that, we had a code base that allowed people to redeem too much. So we actually recently released another algo stable called RB10 Finance, and we did remove the ability to infinitely print like that, and we throttled the redemption to a certain amount. And so RB10 Finance is still going and will have sort of receipt token pools in Janis. So we have basically sort of improved things on our end where we have encountered things that didn't have good results. And also, so we are moving in different directions as far as releasing projects of better quality. So the project that collapsed, which was 10 Meg Finance, was a tomb fork. And so everybody knows that tomb forks generally don't last very long. Maybe 99% of them don't last 1 month. And so Janis, the current project being released, is a DEX, and so a DEX is something that can't sort of give people access to print infinite tokens. And a DEX usually lasts a long time, and it's really something that you can build an ecosystem around. And sort of a DEX ecosystem rewards you for being able to release ancillary projects, which we are very good at. So what I would say is, there were a couple of different types of projects which, we tried and were in demand by users, but we would never run again, like 10 meg finance, and also sort of like short-term rebased DAOs. We didn't really have good results. We didn't really end up with good results from them. So we're moving in a different direction towards projects of better quality. So if we release a DEX and then release some really killer ancillary projects based on liquidity on the DEX, we believe that we can really do good things. And we believe that Janis is going to last, indefinitely or a very, very, very long time. Now, as far as, as far as our team, we have learned a lot operationally by releasing a lot of different projects. We've shown that we can release things and get things out the door and, and release websites around them. And so we have the technical ability in-house to do everything we're going to say here, including the launch pad and all that. Having handled millions in funds before, running the launch pad is not going to be a problem at all. And just in general, because we're so embedded in the community, I believe that we can really be successful in running external launch pads as well. Also, the real narrative right now is real yield. And so this real yield is going to be coming in through all of these different sources. And so it's not going to be a shitcoin yield, guys. When you deposit in the JO and J pools, it's going to be wrapped ether. So that's a really sustainable form of yield. And so if there's yield that's sustainable, it will hold in users. And if we release more DApps that are really timely and that people really want, like if we release the first Libra finance fork on Arbitrum, when that has over 200 million TVL on Ethereum, we believe that, we're going to get tons more users and tons of TVL in the door. And, nobody is really going to pay attention to the fact that we had an algo stable that didn't do well, as long as the current project is doing well. I think there's a lot of forgiveness for founders out there. If people see something doing well, they'll go in. Also, we have the ability to, design this brand new stablecoin and get it audited. We have shown the ability that we have the ability to work with and get along with top tier auditors. We have used multiple top tier auditors, Paladin, and also Janis. Peck Shield. So, basically to those who would criticize, us for our previous projects, I would respond by saying, that's the business. We have had some projects that did really, really well. Like Polly Once a Cracker gave a 7x to token holders plus yield. And, we've had some that didn't go as well, but we believe that Janis Capital will really succeed on its merits and is going to lead to some really good ancillary projects, which could really take us to the next level. And I believe that sort of the Libra finance fork and our own stablecoin that's liquidation free are going to bring in just tons of users. And the new users won't have ever heard of us before.
Yeah, and just to add to that, I think the fact that you're building a house, so to speak, it says a lot, because the majority, when a crypto project fails, usually what happens is the team will shut off the Telegram, change their usernames, and start all over again. And you guys are trying to build, an ecosystem, and I think that should negate all that other crap that other people are saying. You guys are exactly why the kind of teams I look for to put my money in, because I know that you'll keep iterating, you'll keep trying.
Right. Well, so I mean, if you are dealing with the DeFi community and basically community projects in crypto, if you're dealing with people who have been around for 2+ years, like us, well, you can look around and check out what choices you have. I mean, we can look at, well, what ecosystems really are there? Of course, there's Elephant Money, and now their current project is doing well, but actually they had multiple exploits. And I mean, there are many people in DeFi now who Elephant Money represented their biggest loss in DeFi. But that they're showing right now that they can put together a new project, and that project can do well, and now their new project is mooning. And what was that?
No, I was just saying, amen.
And I mean, right.
Keep working.
And I mean, of course, you can also look at Drip. Well, okay, they released farms that were actually a fork of ours. So when Drip released the Manor farm, which really reinvigorated it, they actually forked Polly Wants a Cracker, which was our farm. And then their first Animal Farm version was also a fork of our farms. So there are some people who mistake sort of a project ending with a project failing. So we actually had 4 yield farms that ended, but they had a 2-week pre-programmed lifetime. And so that same thing with Manor Farm. Manor Farm also had a pre-programmed lifetime and then just ended. So if somebody has multiple projects, well, maybe they've just been around a long time. But if I don't think there are that many community DeFi founders who are still on their first project. I think I think most of them have experienced whatever they experience and probably tried to build something else. And so one thing that we always noticed in our experiences is that sort of DEX runners, people who operate a decentralized exchange, they always have the advantage. They just always have people coming to them for services. And that's why this top left part of the diagram is so important, because we have always noticed that if you want a pool, you always have to go to someone who runs a DEX. And sort of we have sort of spent a lot on pools over the years, and sort of so we are familiar with how the B2B aspect works. So we believe that we're really going up in terms of the project quality that we offer, because we're starting up a project that allows us to provide services to lots of users, anyone who wants to swap. And also, so the fact that we're using Uniswap v2 instead of v3 means we're appealing to people who want to set and forget. So the type, I can also go into the type of yield farmers we are seeking. So the type of yield farmers we are seeking are people who are kind of long-term investors, people who are kind of just want to deposit and chill, stake and chill. With Uniswap v3, unfortunately, that is less possible than with other things, because in order for Uniswap v3 LPers to get paid, they have to use concentrated liquidity and set their tick range in a narrow range around the current price. So that requires a lot of maintenance in general, and you have to do that a lot less with sort of Uniswap v2. So we believe that sort of the ease of use is going to be a lot easier with our protocol. And the reason is because once you add to a Uniswap v2 LP, you never have to change the tick range. that's one of the biggest problems with Uniswap v3. So we believe that we can offer sort of an enjoyable experience, and also when we combine it with Farmerland, which was farmerland.gg, which is the yield boosters, the NFTs, you can actually have fun playing Farmerland too. So in Farmerland, it has its own mechanics where there are economics behind, how you upgrade the NFTs in Farmerland and how they gain ability points. And you can sacrifice farmers' land and tools for Minotaurs. And so Minotaurs are what you really want if you want a max boost. So, there are different ways of saving up for Minotaurs that are more economical than others. And you can get wheat from the daily auctions or OTC. And so if you want to take the Arbitrum Janis DEX and turn it into like a play to earn experience, you can definitely do that. And our farmerland.gg DApp sort of makes our yield boosting experience more of a play to earn experience than you get on other dexes, because our Janis Capital contract actually reads the ability, not just what NFT set you have. So you can actually get more yield on Janis Capital by, upgrading your NFT stats over on Farmerland. So it basically Arbitrum Janis DEX becomes a game, a play to earn game, the way very few other dexes have taken it to.
Very interesting. So I also wanted some clarification too. You're not a L2, you're going to be a full-fledged DEX. So people won't be able to trade existing tokens. If you don't have the pool for it, they won't be able to trade, right?
Correct. So if Janis itself doesn't have liquidity for a token, then you wouldn't be able to trade it. So in order to trade on Janis, there would have to be LP for that token added on Janis. Okay. But you're right. So the other side of that is we are not dependent on any other DEX. We will be, a fully fledged DEX, and we will be able to emit the DEX token, and we will be able to provide our own liquidity. And so the liquidity will be ours and nobody else's. Under DeFi Llama, it will be ours. So, so for the purposes of getting our name out there, it will actually be our TVL.
What do you think will be your first mover advantage there? Have you identified anything as of yet?
Yes. So we are actually, in my opinion, the DEX that is going to have the best dividends. So this chart that I keep showing, this flow chart of where the dividends go, that's like a lot of percentages of outside revenue, percentages of all deposit fees. And other dexes just don't give this. Like if you look at what other dexes give on sort of like dividend revenue, I can give you an example. Like, a lot of dexes have what's called the X tokens. So once you deposit, for example, Boo on Spooky Swap, you get X Boo, and it's a derivative of Sushi Swap. So same thing. You stake sushi, you get X Sushi. You stake Boo, you get X Boo. And then you would stake X Boo, and you would have a pool where it would be like generally a syrup pool. Like some other project would give Spooky Swap some tokens, and then they would emit those tokens to X Boo holders, and it would be like 50% APY on X Boo. And honestly, if you are satisfied with that, I don't even know what to tell you. That's just terrible. So that means you have to take exposure to Boo in order to stake it, and then earn a few little extra tokens that somebody just gave as an extra fee to the Spooky Swap owners. That means that you don't really get any real meaningful equity, if you're a Boo holder, But if you're a J holder, you get a transaction fee revenue pool. And of course, if you put funds into the community fair launch, you get JO tokens. And so those tokens get real percentages of every kind of revenue we get. So this is like ownership. It is real ownership in a way that lots of other DEX tokens are not. Also, so that's one sort of first mover advantage in which we have a superior dividend structure to all others, in my opinion. Another thing is this Libra Finance thing that I'm talking about. Actually, so Libra Finance is just on Ethereum right now. They haven't released on Arbitrum yet. And as far as I'm aware, there are no forks. Because they have their own contracts, and just, some people might be a little bit slow in getting the front end ready. But actually, we have the Liquidity front end forked already. So it's open source. And so we have already done some work getting it ready for Libra Finance. And, we think that we are going to have a chance to have the first Libra Finance fork on Arbitrum as well. And that would be a first mover advantage that would be like really good. Also, so you remember I was talking about making a liquidation-free version of an LSD stablecoin, which would be 50 cents worth of Ethereum STETH and 50 cents worth of Ethereum short. That would also be something nobody else is doing. So actually, when I describe that, I might actually be saying too much. I may actually be giving away some intel that I shouldn't be giving away. But sort of, I am anyway. Yeah, I am anyway, because I think that other people are generally not able to follow up on things enough to scoop us on this. I think we're close enough to releasing our stablecoin that other people probably couldn't get in faster if they tried. But the theoretical underpinnings, like the mathematics behind it, do still have to be verified, and so it does have to probably go through an audit. And so so I'm not that worried about it. But that would get that stable coin that is LSD derivative plus liquidation free based on a short would give us an advantage over everything else, in my opinion, because so everybody likes liquidity forks. It's just, my opinion is the problem with them is the liquidation. And, when the liquidity concept is extended to cover guaranteed yield through the LSDs, it really does add appeal. And it's very narrative appropriate. It's with the current narrative in crypto. And so we believe that designing that would give us a very huge boost. It could make us really put us on the map.
And how soon do you think you'll be able to move on that? I'm curious.
Libra Finance fork, a few weeks. The independently liquidation-free stablecoin would be more like months. In all likelihood, we do have to send that to an auditor before we release it, unless we just want to make everyone our guinea pigs, which we don't usually do. So just because we have to schedule in an audit, it would be a couple months or something.
Have you ever considered doing something like Pulse did, where they had their user base testing the code base for them? Like a public testing kind of thing?
Well, yes, we have considered doing something like that, but actually we have generally found it easier to have a designated testing staff. So generally, in my personal opinion, people who are willing to do testing for free, generally it's might not be the best idea. But we have there is a position in software engineering called software engineer in test. You can actually hire testers, and in the past we have hired people to test. So generally we prefer to pay people. I know there are some people who will ask random people from the community to test, but really, so in order to test, a lot of the time you need knowledge. You might need the knowledge to set up a hard hat environment. I might ask the average person, like, do you know how to set up a hard hat environment for testing? And if they don't already know, then them trying to do testing for me is going to be more trouble than me just hiring somebody. Because I would have to teach them everything they need to know in order to become a real tester. And like, so I've also seen, I've seen some other teams do the very humorous thing where they say, oh, we would like to have people volunteer to test for us, but our volunteers must have the knowledge of hard hat and testing practices and all that. So they're basically asking for people to work a job that is like a demanding job and for free. And that doesn't even make any sense to me. Like, so to me, if you want a really good tester, you have to pay for it.
Okay. Fair enough. Good answer. Thank you. Okay, yes. Back to stablecoin, especially with what's happening with Binance, Coinbase, and the SEX like that. His with a little reign of terror going on in crypto right now. Does that scare you? Does that make you a target? What are your thoughts?
So I don't really feel like a target because Ethereum blockchain is fully decentralized, so they can't really pull it offline. And Arbitrum is an L2 of Ethereum. So beyond that, if we're a non, I don't think we can be directly targeted. As far as us designing a stable coin that is based on a 50 cents of ST ETH and 50 cents of Ethereum short, I don't think that really involves regulators at all. It would be like a fully on-chain, fully collateralized stablecoin, and it wouldn't involve external collateralization. It wouldn't involve external anything. It wouldn't be even DAI has external deposits.
I think the part that would interest them is the expectation of profit because it's a it's a stable coin that generates revenue. Right, I think that's the part that would be scary to them.
Oh yeah. So this stablecoin would fail the Howey test. So
right,
of course. So when we are deciding what is and isn't a security, the standard is the Howey test, which is an investment in a common enterprise with the expectation of profit from the efforts of another. Which means, so basically, it would mean that, based on what we're doing with the stablecoin's construction, other people can make a guaranteed profit on it. That's true. So, but that would just mean that centralized exchanges might get flagged for listing our stablecoin. It wouldn't mean our stablecoin can't exist.
Right. Okay. I think that's one of the technicalities people aren't one of the little nuances. The SEC isn't saying that ADA itself is a security. The SEC is saying that the exchanges offering it as a staking thing makes it a security. So I think that's one of the little nuances that people don't think about when that is, and it seems like you have. Okay, thank you for that answer.
Well, basically, the point is sort of this stable coin can be based on everything fully on chain. So we don't need to
one person acting one. Right.
As the centralized people, we don't need to act to do things like put our collateral in U.S. treasuries, like DAI does, for example. Like, DAI, they actually take out their money and they put it in U.S. treasuries and all different other things. But as the people running this collateralized stablecoin with 50 cents of staked ETH and 50 cents of ETH short, that would be the collateralization. That would be it. That would be the formula. We would never take it out. So what would we actually be doing that they could interfere with? Nothing. Because the people who would actually be cashing their coins into ST ETH collateral and getting the tokens out, the people who would actually be executing those transactions would be the users. Like I said, so it would be just user gas making those swaps. I wouldn't be doing it. It would just be, Wojak, my partner, the engineering director, would be deploying the contracts. And then after that, I would be doing the admin functions where we would we would see how much fee we would charge or something. But in terms of where the collateral goes and what happens with it, that would be totally on the users. So we wouldn't have to be dependent on centralized exchanges or anything. So if the SEC wanted to go after centralized exchanges for listing our stablecoin with the expectation of profit, they could do so, but they couldn't actually shut down our stablecoin because it would be sort of contained within the blockchain.
Right, because that negates the whole Howey test thing. Because there's no one person doing it; it's decentralized. Beautiful.
I believe that the stablecoin would still fail the Howey test. It would be an investment in the efforts of another with the expectation of profit. It's just that it would be impossible for the SEC to shut it down because they wouldn't. The SEC would technically be able to go after us and say we are offering people a security and we don't have a license, but they don't know who we are. And so I guess we're basically hiding behind our anonymity there.
So that answers Dear Slayer's question about when will the team be doxxed? Never remember.
Well, right. See, the thing is, I don't think that we can really dox ourselves because we are offering something in this JO token. This JO token, we are saying up front, it's an ownership token. What is ownership? Ownership is equity. What is equity? Equity means that you receive a portion of the profits from the efforts of another. So obviously, JO token is a security and we market it as a security. So if we're marketing something as a security, we can't very well say who we are because we don't have a license for marketing securities. But we believe that the appeal of sort of owning the exchange and having real equity is appealing. It's just many teams can't do it because they're doxxed.
Fair enough. Do you think there's a pathway right now to do it via being doxxed, or is that a wishing on my part?
Well, see, the big problem with the SEC and a lot of what Coinbase is saying right now is sort of there's no way to come in and register. So if there was a way to just go in and register as a securities salesman on crypto blockchains with the SEC, I would be in there right now. And then I would, because you know why I would be in there is because I would be the first person who got that license. Because they like I said, like Coinbase says, there really is no way to just come in and register. And, Coinbase, they don't just have one lawyer. Coinbase has a whole legal department. They have a whole department of legal counsel. And so if there was some way to just walk into the SEC and make everything they do legit, they would be doing it. But I just don't see the SEC taking that path. They seem to be doing everything by enforcement. So they don't really allow crypto salesmen like me to walk into their office and register as a securities offerer. And there's a reason. There is a reason for that. I mean, the reason why they claim that is because anyone can just go buy our tokens on the blockchain. The blockchain is non-permissioned. So the people who buy our tokens, for all they know, could be ISIS, and that really is it. That is the risk that we take. I personally don't think that ISIS is investing in my protocols, but they have been known to receive Bitcoin in the past. And one thing I will say is that actually sort of like ISIS, they won't even take Bitcoin from you anymore because they know it's getting traced. and so I see where the SEC is coming from in that, they want to really tightly control money transmission. So, I'm not saying I'm player hating on the SEC at all. I don't hate them for what they do. I think that they honestly believe that what they do is right, actually. And I believe that they believe that somehow they are protecting people from crypto and that it's better for people to have a CBDC. And so I believe that the SEC believes they are in the right in, forcing crypto exchanges to shut down and forcing everyone onto a CBDC. But being that that's the case, I don't think we can really dox. Because,
Right.
we are offering securities, and we are going to be trying to make a stable coin that's a security.
Interesting. Good answer, sir. Any questions in the room you want to tackle? I didn't see anything that particularly jumped out to me. But,
I actually haven't looked in the room, but if there are any other questions you wanted to go over, I'm more than happy to. I don't even have to pee.
Continuity for the continuity. I like that. Okay, one of my other questions is, you've played on a lot of different chains. Janis is going on Arbitrum. Janis is a DEX. Obviously, the next evolution is a multi-chain. What are your plans towards that? And when can we look forward to that?
Right. So multi-chain deployment. Okay. So first, let me say about multi-chain deployment. Yes, you get free shit. So, of course, everybody always has that question. Okay, when you release on another blockchain, what do I get? Okay, so the answer is you get free shit. So we're gonna have ways of determining how many JO tokens everybody has deposited, and we're gonna give you like a fractional amount when we release on new blockchains. So when you contribute ETH to this fair launch, this community fair launch, when you receive JO and J tokens, we consider that a multi-chain play as long as you don't sell. As long as you hold until our snapshot time, which is when we get the credit statement for the next release, you will get something when we release on new blockchains. So we're not just going to turn our back on the Arbitrum release, when we release in other places, because and then, of course, especially if we release on other blockchains and we start doing launch pads in those places, then we believe that Arbitrum teams are going to start coming to us for launch pads as well. Our launch pads are like a self-fulfilling prophecy. It's like the more you have, the more you get kind of thing. So we believe that if we establish ourselves in on new blockchains, we will get more traffic on Arbitrum as well. But also, so specific places where we might want to release. Well, people have said that ZK Sync is okay, but sort of, I guess the hot one right now, the one where a lot of people are going, is that Pulse chain. Personally, if I have to be totally honest, like, I don't really consider the Pulse chain principle of like replicating the tokens, creating ghost tokens. I don't really consider that the highest end ideological territory. Like, I think that's it's just sort of an empty, sort of nihilistic pursuit of giving free money. But sort of after we release Janis, we would like to mirror it onto, the hottest blockchain that's the flavor of the month. And so, honestly, if I have to hold my nose and release in a place where they have some sort of stinky token mirroring LARP like Pulse Chain, then if that really is the hottest blockchain, then I think we'll probably do that. We just need to make sure that that whatever blockchain we're on supports stuff like subgraph. So there are certain technical requirements and also compatibility. So then ZK Sync, some people don't know, actually doesn't have full EVM compatibility. ZK Sync actually has some functions that are different, and some funds have actually gotten stuck. So ZK Sync actually, we would have to do a little bit of extra testing, but it's probably an okay place to go. And then there are ones like Sui and Aptos. Like, have you heard of Sui and Aptos? Those,
I've heard of Aptos, but not Sui.
Yeah, so those actually have a different programming language. So there are some blockchains that don't actually use Solidity. And so those would actually be more of a handful to go to. It would be more of like a full-fledged project to go over there. But grants might be possible. So there are DEXs that are getting grants to go release on Sui and Aptos. So, but, let's just say not every single blockchain is just really easy to release on. But of course, the principle behind EVM is that it's pretty easy to release on other blockchains. So, I think that we will be looking into it, and those other releases, if we learn any lessons from Janis, we're going to reflect those in the next releases as well. And so, yeah, basically, we don't want to go down with the ship if the blockchain we're on isn't good. We will just give people credit on the new blockchain we release on and just start from there.
I like that. Is there, because it seems like you're doing the cross-chain thing, the cross-chain utility already, because you're some of your... No, you're not, because the NFTs are on RB, and this is going to be on RB. I'm losing my mind. I in my head, Farmerland was still on the old chain. I'm losing it. Okay. There's a question from the audience, and it's kind of a question for me too, but I forgot to ask. There was a private pre-sale. How do you reconcile that with calling this a public pre-sale? And why was there a private pre-sale?
Oh, right. So we can go to the tokenomics. Here it is. So we have a private sale and a community fair launch. So one thing to remember is that we have actually already done a lot of work on the leverage trading platform and also Libra Finance. We already have a front end that looks just like Libra Finance, and we have the contracts of Libra Finance. It's basically, we just have to throw everything together and launch, so we have actually already almost completely put together 2 ancillary projects. And so we're almost ready to hit the ground with those. Would that have happened without a private sale? Well, I mean, it would have been really hard financially because, we have to employ outside devs to make that all happen. We can't just, have these Libra Finance forks. What?
Can't just poof the code into existence.
Right. We can't just poof projects into existence and have these things ready to go as soon as the DEX lands, sort of without doing a lot of development work first. And we have people who we employ as freelancers, and a lot of their paychecks were paid by the private sale funds also. So we have been doing some really good placements and appearances and things like that. That's also, from private sale funds. Also, one other thing about the private sailors is that they are people who I believe want to LP. So they are carefully selected for being people who want to provide liquidity. And so if they are people who want to provide liquidity with their own Ether, then actually they can provide more of it if they are paying less for the tokens. So you might know that market makers often receive tokens, and so that's sort of like what this is. As far as the private sale vesting, it's 0.5% a day. So for 200 days, community fair launch vesting is just 40 days. So only 20% of the private sale is going to come out before community fair launch participants are fully vested. So basically, well, it makes it so that the private sale people get 20% while the community fair launch is vesting, but 80% afterwards. So that means that the private sale participants are highly incentivized to make sure that the token price is good, after the community fair launch portion is over, because the private sailors get 80% of their proceeds after the community fair launch gets all of its tokens. And so one thing we have seen, like when the ARB token came out, for example, the market makers actually supported the price through the initial dumps. Why? Because they kept on getting tokens later, so they wanted to make sure the token price was good for when they got tokens later. And so basically, if we have the private sailors it sort of dawned on me as a way to keep incentives aligned. It basically creates a group of people who know that they're getting tokens later, so they will want to boost the token price up front. Why is that important right now? Well, we're doing the community fair launch in 2.5 hours. And so that means the private sailors will probably want to put money in the community fair launch as well, which of course is good for community fair launch participants. Why? Because the private sailors, what they get is dependent on what comes into the community fair launch, really. And so we also have some tokens for devs, but they come out very slowly. And the extinction pools are a pre-minted supply, like I said. So the extinction pools are, we only get that much ever. And after that, no more extinction pool supply can be minted. And then, so ecosystem development is stuff like centralized exchange listings. So for example, I believe that it is pretty easy actually to get our token listed on MEXC, the exchange. So when we do, they will want tokens, and they will also ask about market making. So that is basically the explanation there. And also, go ahead.
I was going to say, since you're on the subject, can you break down the team, what the team will be getting, all that good stuff for me?
Yes. So the team actually gets 50,000 tokens vested at 0.2% a day for 500 days. The team also gets 12% of what comes out for farming. So the team will actually end up with like 12% of the total tokens after a year. So then also the team gets, from the community fair launch, the team gets 20% of the ether. So when we launch liquidity from the community fair launch, we get the guaranteed 3x on J tokens by launching. Out of 100,000 J, we use 29,412 for liquidity, and we use 80% of the ether that comes in. That is how we get the 3x public price for the launch. But that means the team receives 20% of the contributed ETH. And then also on the flowchart, we also see that there is some portion of the outside revenue and deposit fees and non-native deposit fees that goes to the team as well off the top. So we believe that having a team cut in there keeps incentives aligned so that we are incentivized to go out and seek out B2B business clients, because, you know, it makes it easy to justify putting in time to seeking out B2B business clients, you know, when the team actually gets to keep some of the funds that come in as well. And then the team actually also receives JO tokens. So the team also gets a major stake in the JO ownership pool, which we also believe keeps incentives aligned, because so this means that JO holders from the community fair launch get to harvest their profits in the same way as the exchange operators. So we will all be harvesting the same way.
Okay. Thank you. I'm looking to see if there's anything else from the room. I guess since we've had some people that join us, maybe you can, we're towards the end of this anyways, maybe you can give us a recap, give me your elevator pitch, you know, for somebody who fast forwards to the end of the video. What's your keynotes?
Great. So, yeah, so Arbitrum Janis DEX will be a decentralized exchange on the Arbitrum network. So our key aspect is being community owned. So we have pools for J and JO tokens, which will receive the majority of the revenue that comes into the exchange. Also, we will have lots of features for yield boosting. Farmerland NFTs from farmerland.gg will be used for yield boosting. We're going to use the Uniswap v2 code base to make sure that you don't have to keep setting settings. So in my opinion, it's better and leads to a more set and forget experience than Uniswap v3. We're also going to have the ability to accommodate lots of other businesses in what they want to do. We're going to have NFT pools, which means we can bring utility to any NFT set, a launch pad, which means we can launchpad other projects and give them farms and pools. And we're also going to have internal launchpad projects with like leverage trading and, a Libra Finance fork. Basically, one thing I want to emphasize is the community fair launch is in just 2.5 hours. So the community fair launch, the punchline is you get a guaranteed 3x. The community fair launch has up for bid a pool of 100,000 J and 10,000 JO tokens. And basically, the amount of ether that comes in will give us a J price. So it'll be, however many, it'll simulate the process of doing a real fair launch, except everybody gets the same price. And then we're going to see how much ether comes in over 3 days. And then we're going to launch J tokens at 3 times the public price. And then everybody gets tokens at 2.5% a day for 40 days. That's J tokens. Also, you get JO tokens as a free bonus. So the JO tokens are going to be all released all at once up front. No extra charge. So basically what this simulates is money coming into a fair launch, except we're giving everyone a chance to sell at the top if that's what they want to do. Because when the 3x happens, when we launch the token at 3x, the public price, there won't be anybody who has like a large amount of J tokens. There will be an opportunity to claim, however much you're entitled to, and sell at, almost launch price. Plus, we expect the price to go up at first. When we launch the token, really, we expect some people to buy anyway at 3x public price. So we expect this to be very profitable. When Grizzly Fi did a similar formula, they got $26 million worth of BNB in their fair launch. And that's because sort of the 3x, the guaranteed 3x, it accommodates however much ether comes in. There's no requirement for the amount of ether for the 3x to be valid. You can do it with however much you want. Plus, in addition to the guaranteed 3x on the community fair launch for JO is going to be given to you as a free additional bonus at no extra charge. So, if you want, you can sell it and get some ROI right away, but we prefer that you deposit it in that JO ownership pool. Also, you can LP with it. So one thing I haven't actually said in other appearances yet is that our MasterChef will have decently high multipliers for JO. So if you get JO in the community fair launch, you can also pair it with Ether or USDC and LP with it. And then if you do that, you can get very high rewards. So part of the yield incentivization is to get that. It unlocks the keys to high yield. So we believe that the fair launch is like a no-brainer in and of itself. It's an instant 3x. However much you pay for the J tokens, you get them at 3x that price, and they start out at 3x that price, and you can start claiming 1 hour after the presale ends. So the turnover is actually really fast. The people who do the community fair launch get to start claiming at 11 or 10 p.m. GMT on 6/12, so 1 hour after the community fair launch ends. All the other emissions, like the MasterChef, begin on 6/13, on June 13th at 9 p.m. GMT. So we are really happy to be able to offer you this community fair launch because we really think that it's an amazing deal. And I guess that basically wraps up my summary. Do you have does that sound good?
Yeah, that did it pretty well. Yeah. Let's see if we the questions I see in the room are fairly generic, and you've kind of answered them already. That's why I'm not picking any. But somebody wanted to know if you could pee yet. I think that's a very relevant and pressing question.
Not quite.
Not quite. Okay, so I see people still talking about the fair launch versus the pre-sale thing, but I think that makes perfect sense. You know, you can't poof things into existence, and it's really annoying to. It's gotten very annoying for me to pay for projects, to hire somebody to do something, and then waiting there for the thing to happen, and it never happens, and then the project dies and my money goes away.
That's totally relevant. And I don't, again, I'm not, the last thing that I would ever want to do is like start a public shit fight with other projects during our AMAs, So
no,
we're not here to bash other projects.
No, I wasn't bashing anybody.
No, right. But like I do appreciate the fact that in order to have quality development on a timely basis, guys, it really does cost money. And if you guys saw all the things that have gone on my expense spreadsheet over time, your jaw would hit the floor. I guarantee you, just because, running a business is expensive. And so we do have these 2 Launchpad projects that I'm talking about almost ready to go. And, we also successfully, those, right. And we paid also. So remember also, we paid for a very expensive audit. And I can even just tell you, because if people are still on the topic, I can tell you, I actually paid $23,000 for the Peck Shield audit, guys. So, I mean, there are certain services that we have gotten that are very high level services, which will benefit us all for all deploys. And, in order to pay for that stuff, in order to do what we do at the highest level, we do have to have some funding. I mean, and, there are some project runners out there who would cheap out even if they have the funding. But, we don't want to, we are really intent on bringing you guys, the best products we can. So, but also just on the topic of the private sale, we have the private investors do get 10,000 JO tokens, but they're staking them, I believe, and or providing liquidity. So if we want to have liquidity in JO tokens, it is good for the private investors, if they intend to provide liquidity, to have tokens, because then they will be able to provide liquidity at less cost to themselves, and therefore we will all have more liquidity. As far as the J tokens, again, only 20% of the private sale vests before the community fair launch is completely done. So community fair launch will vest 100,000 tokens in 40 days, so 2,500 tokens a day. The private sale will vest 100,000 tokens in 200 days, so they get 500 tokens a day. So while the community fair launch is emitting tokens, it gets 5 times as much as the private sale. So, I mean, you can complain if you want, but as the community fair launch participants, you get to dump 5 times as hard as the private sailors. So really, if you are in the position of the private sailor, your motivation would be to make sure that the token price is as high as it can be at the end of the community fair launch emission. So if I were doing this private sale, my motivation would be to make sure the token price is as high as it can be on day 41. Because that's my time to shine. Like, the private sailors start to get more proportionally after day 41. So in my opinion, the people who did the private sale are motivated to increase the price of the token until day 41, which is the day Community Fair launch is no longer releasing. But that's also so, if you want a reference on sort of like one other, good reason to do this, you can look at like the Solana sale in the past, for example. Like, if you get private sailors who are influential people on board at an early stage, then they can do things for you later. Like, what did, for example, the Solana crew gave SBF a big initial allocation. And then what did SBF do? He started up a whole ecosystem for them. Say what you want about SBF. They had, a lot they did to support Solana. You can see in starting up a project that you intend to last a long time, you want to set up key stakeholders in a position where they have an incentive to continue what they're doing.
I think you're in a unique position to answer this question for me, because I personally, I've talked to a lot of projects. I've been in a lot of projects, and the constant thing in the rooms, the constant thing is when marketing. I personally think that marketing is a meme. What would you? I think, given that you've had successful projects, you've had the flops, you've had the whole gamut. To you, what is marketing, sir?
Like, so to me, I agree. So marketing can be important, but marketing takes on so many dimensions. So marketing can be paid or unpaid. So marketing, in my opinion, is all about the counterparty doing the marketing. It's not about how much you pay. Like, so for example, there are many people who sort of go around assuming that we pay for certain promo that we don't pay for. And there are certain people who have misconceptions about the price. So to me, marketing is more about influence. So we can pay for marketing. Like, so one reason why the private sale is important is because it's enabled us to purchase some nice placements. Like, so pretty soon we should be seeing some good placements coming out for us. But sort of, I have seen some that are very highly priced. So for example, there's this YouTuber called The Defiant. They asked us for $15,000 for a video. I'm still in negotiations with them, but so there are some YouTubers who will ask for whole budget. So is that marketing? Like, so me personally, I don't think it's really smart to give one YouTuber your whole budget. But we've done all kinds of marketing though. We've seen sort of we've done banner ads. I've spent up to $20,000 for a week of Dex Tools banner ads before. But sort of there can be questions about intentionality. So I guess if you want me to make sort of a statement about marketing, I will make this as my main statement. Okay, so in marketing, there is a difference between attention and intention. So there are some forms of marketing that have very high levels of attention. Like, so when we did Dex Tools ads, for example, we got a lot of attention because there are lots of people, random people throughout the world, apes, who go on Dex Tools just to look at random information about tokens. Except they may be going on Dex Tools to look for information about whatever token they want. And so they might not really care if they see your banner ad, to be frank. But then, so that's Dex Tools, I would say, is an example of high attention, low intention. Well, medium intention, because sometimes people go on Dex Tools for things to ape. But so we've also done Polygon scan ads. And so with Polygon scan ads, we got less of an impact than Dex Tools. Why? Because if you're going on Polygon scan, you're probably not looking for a project to ape. You're probably looking for just information on your own wallet, information on a transaction. So Polygon scan, I would say high attention, low intention. So, but then on the other side of the scale, I've seen some like YouTubers who have like a pretty low number of views on their videos, but actually have like a lot of people aping into whatever they say. Like, and so for example, I would say Bartertown is one of those. Like, so for example, like if you go to his videos, like, and check the videos that he's done on us, like the view counts are like they're decent, but they're not like incredibly high. But so when people see them, they ape. Like, just so when people are in Bartertown's community, they gain a very high level of intentionality. They are highly likely to ape projects that he recommends. And so I would say that it's important, if you are a project runner, to sort of ally yourself with high intention marketing. It's best to get behind marketing that will actually lead to user conversion. And so that user conversion rate of the marketing exposure is the most important thing.
There is something to be said about presenting it to the right audience, right? That's wonderfully said.
So I think we could do like one or two more questions or something.
Okay.
Or is there one?
Is there? If you have any questions, feel free to raise your hand. I will unmute you. This has gone long enough. We're going on 2 hours now. I appreciate you taking the time, sir. You're always unless you have to pee. Usually, you give me plenty of time, which I usually need to understand things.
Sounds
so
good.
Thank you.
But yeah, if nobody's raising their hand, I just want to say again, our pre-sale, our community fair launch starts in just 2 hours now. So please go to janis.capital and then click fair launch. Just go here, janis.capital, and click community fair launch. It's on Arbitrum Network, and you can put in unlimited Ether for 3 days. When you do, you get Janis tokens at 3x public price, and everybody gets the same price. It's a community fair launch, meaning everybody gets the same price. It's not one of those unfair fair launches where everybody gets a different price. You get the same price as everybody else if you put Ether in. And when the token launches, you get 3x. It launches at 3x the price you pay. Tokens release at 2.5% a day for 40 days. And guess what? You get extra free JO tokens. So for every 1 J token you buy, you get 0.1 JO, which you can either sell or put in the JO ownership pool or LP. So you can do lots of things with JO tokens, especially earn the dividends that come out. And, we hope that because there are so many things to do with JO tokens and so few tokens, we hope the price will be high. But really the point of JO tokens is just a free bonus for you so that you can own part of the exchange and get all of these awesome, ownership benefits. All of these revenue sources are coming to the pools. So again, we hope you will join us. It's at janis.capital. And if nobody's raising their hand, I guess just, again, thank you very much to DeFi Cult and Tiamat, the host. We really appreciate it. I think you're the best host. So, of course, we're always happy to be here.
Aww.
And, again, we think that this Janis release is going to be the start of a great, great flywheel ecosystem. And again, we have some very nuclear level DApps coming out. Libra Finance Fork, leverage trading, and stablecoin. Also, we want to release a bot trading contract. I know some of you know about the Euro Slut bot from Farmerland, which is doing very well. We also want to release a bot trading fiduciary contract for that. We'll be with you on that shortly.
I'm looking forward to it, sir. Thank you again for stopping by. I look forward to speaking to you again. The recording will be on the YouTube shortly. And
great, yes, share it, and we'll share it.
Yes, please. Let me turn off the recording. And thank you again, guys.